$3 trillion. Gone.
Imagine looking at the global market and seeing the size of, I don't know, the entire UK economy just burned away in one day.
It's not a slow bleed either. This was a single catastrophic event. We saw silver plummet from an all-time high of $120 down to $78.
That's a 35% drop.
Yeah.
In 24 hours.
And gold went with it, down 12%. It was a liquidation.
And that's exactly where we're starting this deep dive. We've gone through all the latest reports, the market data, everything, to answer one, frankly, terrifying question.
This is just a panic?
Or was this an engineered flush designed to wipe you, the retail investor, completely off the board? Because the official story and the data, well, they just don't line up.
Not even close. I mean, turn on the mainstream news and you'll hear a very neat and tidy story.
Right. It's all about President Trump nominating Kevin Walsh to be the new Fed chair.
Yep. Walsh is a known hawk. He wants a stronger dollar, less money printing, and the simple logic is strong dollar, weak commodities. So silver and gold go down, case closed.
It's a plausible story. It really is. But it feels like saying the Titanic sank because of an ice cube.
It ignores the mechanics.
Exactly. The Walsh news might have been the match, but the data we're seeing suggests someone else spent weeks, maybe months, carefully stacking dynamite right under the market.
And that's what we need to get into, because this wasn't just a market event. It was a sophisticated operation. And to see the fingerprints, you just have to look at the timeline.
The timing is, suspicious doesn't even begin to cover it.
Okay, let's start there. The Friday factor. Why Friday?
It's a classic move. The big crash was engineered to happen right as the Asian markets, Shanghai, Tokyo, were closing for the weekend.
And why does that matter so much for silver?
Because Asia is where the physical demand is. China, India, they are the ones buying up the actual metal.
So you wait until the biggest buyers are literally asleep.
You take them off the board, you remove any support for the price. If this had happened on a Tuesday morning, Chinese buyers would have stepped in and bought that dip so fast.
And the crash would have stopped.
It would have been a blip. But on a Friday afternoon, with no one there to catch it, the price was just allowed to free fall.
And this happened right after an all-time high. Everyone was euphoric. And then it's like the lights went out. We have to talk about the system failures.
Oh, the glitches. Yeah, it's almost film-worthy.
So the price is collapsing. What happens?
The London Metal Exchange, the LME, the second most important place for metals on Earth, just goes offline.
You're kidding.
Nope. Systems down. And at the same time, we're seeing reports that HSBC's trading systems also went down.
And HSBC is a major player. They hold a lot of short positions.
A huge player. And let's just quickly define that. A short is a bet that the price will go down. So if you're HSBC, you are losing billions of dollars as silver goes to 120. You need the price to crash.
So the one bank that desperately wants the price to fall suddenly has technical issues right in the middle of the chaos.
It creates a fog of war. But here's the thing. Not everyone was flying blind.
Okay, this sounds important.
This is the smoking gun. This is the piece of data that makes you sit up and realize this was not an accident.
That happened.
Our sources show that amid all the chaos, with systems failing and people panicking, JPMorgan.
Go on.
JPMorgan managed to close out their entire massive short position at the exact bottom of the market.
Wait. So they bet the price would go down. The price crashes. And they perfectly time their exit to cash in at the lowest possible point while other people can't even trade.
That's what the data says. It's an execution of impossible precision. It's like the lights go out at the casino and one player walks away with all the chips.
Unbelievable. And there was a distraction too, wasn't there? The fake news report.
Yes. Right in the middle of all this, Reuters puts out a story. They claim the U.S. government is ending support for strategic metals.
Which would obviously tank the price.
And it did. The algorithms read the headline and just started dumping. It didn't matter that the Department of Energy came out later and called the report false and misleading.
The damage was already done.
It was the perfect air cover. It pushed the panic over the edge.
Okay, so you have the timing, the glitches, the perfect exit, the fake news. But how? How do you actually force a 35% drop?
Yeah.
There has to be a weapon.
There is. And the weapon of choice wasn't news. It was Margin.
Margin. This is where it gets technical, but this is how they do it. Let's break it down simply.
Right. So most people trading silver aren't actually buying bars of metal. They're using futures contracts. And crucially, they're using leverage.
So borrowed money.
Exactly. You might put down, say, $10,000 of your own money to control $100,000 worth of silver. That's 10-to-1 leverage.
Which is fantastic when the price goes up. You can make a fortune.
It's intoxicating. But there's a catch. The exchange, in this case the Chicago Mercantile Exchange, or CME, they set the rules. They decide how much money you need to have in your account. That's your margin.
And they can change the rules.
Whenever they want, with no warning. And that's the trap.
It's like you buy a house with a 10% down payment, and then Friday afternoon, the bank calls and says, yeah, we need another 40% by 5 p.m., or we're selling your house.
That is a perfect analogy. The CME aggressively raised the margin requirements right as the price started to fall.
So what happens if you don't have that extra cash just sitting there?
You get a margin call.
And that means?
That means the exchange's computer system automatically sells your silver position to cover your debt. They don't call you, they don't ask, it's just sold.
And that's the flush.
That is the flush, because your forced sale pushes the price down even further, which then triggers a margin call for the next person in line.
Their sale pushes the price down again.
And it hits the next person,
Yeah.
and the next. It's a cascade, an avalanche.
A snowball of forced selling rolling downhill.
And here is the most important part. The exchange has the order book. They can see everyone's positions. They know exactly where the pain points are.
They have a God mode view of the entire market.
They do. They know that if they raise the margin by X amount, it will cause Y amount of forced selling. It isn't a guess, it's just math.
That's like the casino, knowing your hand and then changing the table minimum to an amount they know you can't afford.
They're clearing the table. And the thing is, this isn't new. This playbook is as old as the hills.
It's happened before.
Many times. You look back at 1980 with the Hunt brothers.
They famously tried to corner the silver market.
They bought up so much physical silver, the price went vertical, the big banks were on the ropes, so the exchange just changed the rules.
What did they do?
They instituted a rule called liquidation only.
That sounds bad.
It's exactly what it sounds like. You were only allowed to sell. The buy button was literally turned off for the entire market.
So there are no buyers allowed. The price can only go one way.
Down. It crashed 80%. The Hunts were ruined. The banks were saved.
And we saw it again in 2011, right?
Yep. After the financial crisis, silver ran all the way up to $49 an ounce. The CME raised margin requirements 5 times in 2 weeks.
5 times. That's not a subtle move.
It was a sledgehammer. The price crashed 48%. We even saw a mini version in December of 2025. Margins hiked twice during thin holiday trading.
So every single time the little guy, the retail investor, starts winning, the rules get changed to flush them out.
That is the pattern. It highlights this huge disconnect we have to talk about.
The difference between the paper market and the physical market.
This is the core of everything. The paper market is the futures contracts, the numbers on a screen in Chicago and London. That's where the $3 trillion just vanished.
But the physical market,
The actual silver bars and coins that you can hold in your hand,
Yeah.
that's a completely different universe.
and the sources we reviewed argued this crash was just a reset of that paper market. But did it change anything about the real-world supply and demand?
Not one bit. And that's the great paradox here. While the paper price was getting annihilated, the fundamentals of physical silver have never been stronger.
We are in the 5th straight year of a silver supply deficit, right?
5 years running, we use way more silver than we mine, and the demand is just exploding.
From what sectors?
All the ones building the future.
Yeah.
Solar panels, electric vehicles, AI data centers.
You need silver for the chips and the conductivity.
You cannot build our high-tech world without it. It's the most conductive metal there is. We are short hundreds of millions of ounces every single year.
So on one side you have bankers crashing a digital price, and on the other you have Apple and Tesla and every other tech company desperate for more physical metal.
Exactly. And you can see this split in the data. Look at the Shanghai Premium.
Explain that for us.
It's basically the extra cost you have to pay to get an actual bar of silver in China versus the paper price in London. Right now, that premium is at an all-time high.
So the paper is cheap, but the real thing is more expensive than ever.
It tells you everything. It tells you that in the real world, where factories need to build things, silver is incredibly scarce and valuable. The real price is breaking away from the paper price.
It's like the paper market is trying to gaslight the entire global economy. Okay, so let's look at the scoreboard from this great flush. Who won? Who lost?
The winners clearly were the commercial shorts, the big banks. They got to cover their bad bets at rock-bottom prices. They cleared their books and probably made a fortune.
And the losers.
The retail public, the people using leverage got completely wiped out. The mining stocks got hammered, down 12, 15%. Anyone who panicked sold at the bottom.
It's infuriating because, people listen to this show, they do their homework, they see the supply deficit, they make a smart bet.
And then the rules of the game are changed mid-play.
You can be right on the fundamentals and still lose everything.
One of the analysts in the reports we read put it perfectly. He said the crash looked like total chaos. But if you look at the data, it moved like an orchestra following a single conductor.
A chilling analogy. An orchestra of destruction.
It implies coordination. It implies this wasn't panic, it was a plan. And that forces you to a really uncomfortable conclusion.
Which is what?
If you're playing in their sandpit, the paper market, you're sitting at a table where the dealer not only sees your cards, but can invent new rules at any time.
So where do we go from here? Does an event like this destroy trust in the system?
It has to. I mean, why would you own a paper contract if you know it can be devalued 35% overnight by a committee? It pushes people away from paper and toward the physical asset.
Because you can't get a margin call on a silver coin in your safe.
Exactly. There's no counterparty risk. The exchange can't force you to sell it. A bank can't just delete it.
The only safe move is to exit their game.
It seems that way. The paper manipulation can only last so long before the physical reality takes over. You can't build a solar panel with a futures contract. Eventually, the factories run out.
But until then, the volatility is the weapon they use to shake people out.
Percent.
Okay, let's wrap this up. We started with a $3 trillion crash. The mainstream story is it was about a new Fed chair. The data suggests something else entirely.
The data points to a coordinated flush. The timing, the system outages, the margin hikes, and, the impossibly perfect trades from the big banks.
It's the same playbook we've seen again and again. But the real-world story, the supply deficit, hasn't changed.
If anything, the fundamental case for owning the metal is even stronger now. The price is lower, but the scarcity is much, much higher.
So here's the thought we want to leave you with. Maybe the real divide isn't between smart money and dumb money. Maybe it's between inside and outside.
That's a really powerful way of looking at it.
If the house can change the rules of the game anytime they start to lose, is it even possible to win? Or is playing in that paper market just paying to be in a casino where the odds are mathematically designed for you to lose?
And as we move into this future that's going to be defined by real resources, I think the question for everyone is, do you own the asset or do you just own a digital claim on the asset?
Because we just saw how quickly those claims can disappear. A sobering thought. We're going to keep following this because I have a feeling the Great Flush was just the opening act.
I'm sure we'll be talking about this again.
Thanks for diving deep with us. Stay skeptical and maybe take a look at your portfolio. We'll catch you on the next one.